We're ready to go.
Sounds good.
Alrighty, guys. My name is Zach Archer here. I am a real estate agent in Indianapolis, and today I wanted to do this video with Chris Kerr. He works with Elements Financial. I wanted to bring him on here to chat about the mortgage process a little bit for first-time home buyers, even second-time home buyers. If you have any questions, I kind of attack this in a way of not knowing anything. So we're going to start from the very bottom here, kind of work our way up. But Chris, I'll let you go ahead and give yourself an introduction. Just kind of tell me about yourself. How long have you been in the industry, and then how did you get started?
Yeah. Well, Zach, my name is Chris Kerr, work for Elements Financial. Been in the industry approximately 17 years. Moved to Brownsburg 17 years ago when I got married to my wife. She's a teacher in Brownsburg, and we have two kids. My son Jackson's 15 and plays baseball. My daughter's 11 and plays, she's in gymnastics. So, met someone back in 2006 that was a mortgage broker and ended up working for him for about 10 years, taught me everything he knew. It was mainly just he and I for a long period of time that I was able to learn a lot from him, and he's still around and good friends with him. So Denny Frecker,
awesome.
Give a shout out. He's a good guy. So
awesome, man. So you've been in the industry for how long did you say?
About 17 years.
Oh, wow. Okay. So, being in something for 17 years, you learn a bunch of things. If you could just share with me like one or two things that have kind of helped you get to where you are today in your career.
A couple things that I would say that stick out to me is something that in order to be successful in this job, you have to have time management, and in some way, shape, or form. You've got to be someone that is self-driven and can, get up every day and go to work, because in a job where you kind of work for yourself, if you take the day off every day, you're not going to get very far. So being self-driven is an extremely important thing to be able to do. And then the other side is availability. The biggest thing I heard a long time ago when I got in the industry is answer your phone. If you don't answer your phone, you might not stay in this business for very long. So return phone calls and answer those phone calls when they come in. And sometimes I get looked at sideways when I'm on vacation with my wife and we're out to dinner or we're at an amusement park, and I take that phone call, but you never know when you're going to get that opportunity to get in front of somebody to earn their business. And that's I try to always answer my phone or texts, and if not, get back to somebody within an hour to be able to help them out. So
awesome. Well, yeah, I just want to do a quick little introduction. Thanks for sharing that info. Wanted to kind of jump right into the questions today. For those viewing, I'm going to put like time frames and the questions so you can go find them easily. But we'll just start from the very, very basic stuff. So Chris, kind of the first question would be, what is a pre-approval? How do you get approved? And why do you need the pre-approval?
Pre-approval is a piece of paper that you would provide to a seller that it's going to show that you're qualified to purchase that home in the price range that they're wanting to offer it in. When you go to see someone's home to determine if you want to buy it, there's a lot that goes into that for the seller, having to leave, get their kids and pets out of the home, et cetera, and getting pre-approved to show that they have someone that has talked to a lender that's serious about buying goes a long way. And, it's a serious thing for that seller. So take it seriously. Make sure that you've talked to somebody that can get you taken care of and get there. A conversation that I often had with my wife when we started to think about upgrading was, don't look at houses until if you can't fall in love, don't go looking, So make sure you got your ducks in order before you go out there and start looking at houses.
Yep. Especially in a market like that we have right now.
Even more so now.
Yeah. Being able to have that ready to go means a whole lot, especially if you fall in love with that house and you're ready to strike on it. If you don't have the pre-approval, sometimes it could take a day or two to get it. I know you're pretty quick at it, but if they don't go with certain lenders, they might take a little bit more time.
And I will say too, though, some files are more complex than others in determining this. You know, sometimes I can make a decision in 5 minutes, and then if you're self-employed, man, that opens up a whole can of worms that I got to dive into. That's going to take some time.
Yeah, absolutely. Awesome. Next question would be, what are some of those things that buyers are looking at that could potentially set them apart to win with their pre-approval?
You know, I've often said a pre-approval is only as good as the person that distributed it, you know, that they gave it out, because you can go online and get a pre-approval, but it's only as good as the information that you put into it. But at the same time, it matters the person that you're working with, that they've dug into it to make sure that what you put on the application backs up what, you know, what's on there. I've seen that happen many a times, that mistakes are made by people when they're filling out their application, or they, you know, hey, I make this much a month. Well, not exactly. You know, I have to dig into that. So the name of the name of the company that's on there, as far as the lender, can matter, especially here in the local market. You know, Elements has a great reputation of getting loans to the closing table. People know the name. We were the number one financial institution for mortgages. By that I mean banks or credit unions in 2021. So we pride ourselves on that, and it's, you know, having that pre-approval letter. I know that there's been times that if all else was equal between two offers, and you have one from that's local and one that's from that nobody's ever heard of, chances are they're going to go with the one that they trust, the name that they trust.
Yeah, and that's huge. And that's just something that I've learned being in the industry, is those small things matter on your offer. It's like, who do you have lending? Are they going to close on time is number one question. And, you know, how reputable are they? So awesome. I've heard this question come along, me personally, from some people that have kind of wanted to buy a house. And it's all about getting pre-approved. Does it affect your credit? How much does it affect your credit? And then if you already have low credit, if you think you have low credit, what are some ways that you can improve it quickly before going to get pre-approved?
You know, I get asked this question a lot when people go to apply. Oh, are you going to pull my credit? Yeah, we're going to pull your credit. And, you know, we've got to pull the Band-Aid off and look at it to be able to give you a good reading, and to be able to accurately, you know, tell you what it is. I've had people list off their debts and all this, and I'm like, no, I got to see the score. I got to see what's on the credit, how it's there. And can it affect your credit score? Yeah, probably 1 or 2 points when you get it pulled. If you had 40 people pull it, you know, you're going to have a major effect. I think it's more of a scare tactic that other lenders put into people to scare them from preventing them from shopping. Go shop. Come back to me when you're ready, is my personal belief. And you're going to be better off having a conversation with a loan officer. If that person actually knows what they're doing, they're going to put you in a better position credit score wise, and teach you stuff about your credit as they go through it and analyze it, to make you stronger after the fact. I can pull a report that tells somebody, hey, you're right on the tier of being over 720, you're at 717. If you go pay your Kohl's charge down $125, your score is going to go from 717 to 724. That changes your rate. That's good information to know, that if it's not being shared with them, they might not know. So
absolutely,
I wouldn't be too scared about having somebody pull my credit. The people that I think should be worried are those that are close to that cutoff line of that 620 number.
So I know when you guys look at, you know, getting qualified for a loan, there's a few things you guys look at. You know, you said credit score. I know debt to income comes up a lot. Can you share a quick way for people to kind of calculate how they could get approved with their own debt to income ratio, and like what that is?
Call a loan officer. They'll figure it out for you. You spend too much time trying to calculate it and figure it out, and you don't know what you're doing, you spend a lot of time spinning the wheels and not going anywhere.
Right.
But with that being said, calculating debt ratio is pretty simple in that, the rule of thumb that I give, and I'll use a pretty simple example, is to say, if you make $60,000 a year, that's divided by 12, that's $5,000 a month. And the rule of thumb would say Fannie Mae or Freddie Mac will approve you up to 50% debt to income ratio, which is to say, if your monthly income was $5,000, 50% of that is $2,500, right?
Right.
So all debts, including the house payment, need to be $2,500 or less.
Okay.
I don't want it to be at 50% because a dollar one way or the other can swing things greatly and be extremely stressful. But it's a good rule of thumb and a good starting point. I think the numbers they like to see are really more 29 and 41 are a couple of the numbers that I think are significant, which is to say your housing ratio is 29% of your total income, gross income, not take home, but gross.
Right.
And then all debts, 41% of your gross income, including the house payment. So
they're looking at like your house, if you got student debt per month, if you've got your phone bill, your car payment, all of those have to be combined with the house payment. It's got to be under a certain level.
Yep. Not looking at utility bills, not looking at, how much you spend at Target every week.
Right.
We're not looking at those types of things, but the things that are on credit that report monthly. Child support would be one of those things that would be included in there, things like that.
We talked a little bit about like self-employment getting pre-approved. This is a big topic. A lot of people are self-employed these days.
Yep.
How does that sort of employment affect someone's ability to get pre-approved? And then if you are someone that is self-employed, what do you have to do? What do you have to prove to get pre-approved?
I'll kind of answer this with two questions or two areas, is to say self-employed and commissioned employees kind of are in the same boat in that you need to have a 2-year history of that type of income to be able to establish any sort of income. And the rule of thumb I would give is, let's say somebody got into car sales, the first month they made $30,000, doesn't mean that they're going to make $30,000 every month for the rest of their life. There's a big sway in that. And that's why we have to look at it from a snapshot of 24 months. And for self-employed, we want to see 2 years worth of tax returns to be able to establish what that looks like. The longer you've been in it, it might end up only being 1 year worth of tax returns, but I won't know that until I run it through the automated system and Fannie Mae or Freddie Mac tells us what we got to have. And you wouldn't believe how many times people say, well, I make this much money, but on those tax returns, after you write off all certain things, what matters at the end of the day is what you're paying taxes on. That's what you're telling the government. I made, $85,000 last year. Well, then you're paying taxes on $85,000.
Right.
If you pay taxes on negative $15,000, you didn't pay taxes. You made negative $15,000. Well, it might be nice for that tax check. It might not be. It might not feel so good when you go to buy a house.
This is just one question I just wanted to throw in here. We didn't cover it, but like, very simple question. Going to get pre-approved, what does that simple process look like? A lot of people think it's difficult. Is it a phone call, just an application? What does it usually look like?
So for me, I generally like to have a soft introduction with, from a real estate agent to say, hey, this person's wanting to get pre-approved. I like to first have that conversation with them because the next step is to have them apply online. It used to be days of old where I would manually take that application over the phone, going through the application. It would, be a little bit time consuming. Nowadays you can fill that application out online, but sometimes that information gets lost in translation of what they put into the application.
Right.
And it's good for me to have that conversation up front where I talk through their qualifications and what they're trying to accomplish, get to know them a little bit, and then, have them go out and fill out their application online. And then depending on how quickly that, if it's Saturday morning and, hey, we're going to put an offer in on a house at 4:00 today. Can you get that pre-approval back to me today? Yeah, we can make that happen. If it's any, if it's a make sense deal. But if you're getting into self-employed and I got to get 2 years worth of tax returns and you got to get a hold of your CPA for your business returns, that can be, it might not be as simple, but if you're a W-2 employee, those flow a lot quicker than the other ones.
It's a pretty easy process, realistically.
I would recommend people get pre-approved in advance. Those pre-approvals are good for 120 days. That's how long that credit's good for. And all we have to do is really re-pull credit if that expires, and make sure things get updated throughout the process. If you're changing jobs, you better let your loan officer know about it.
We're going to dive into some options that people have. So I know just from being in real estate, you've got like your FHA, conventional, USDA, VA. What are those loans? What are some differences? And then just briefly cover kind of how do you qualify for each of those loans?
Well, we'll first talk about the government products, which are like FHA, USDA, and VA. And this is a pretty, broad stroke that I'll give here, is to say FHA is more of your first time home buyer product, 3.5% down payment. You're going to have monthly mortgage insurance. And generally, the people that I see using FHA right now are credit scores between 620 to 680. A little bit more lenient on that debt to income ratio. Instead of 50, it might give you a little bit more than that, maybe 53%, just depends. USDA is a great product. It's 100% financing, but they have income limitations, which is to say you can make too much money. And then you also have, it has to be in more of a rural area. So like Western Hendricks County, not Indianapolis, but more in the outside rural areas. It doesn't mean to say like, if you're buying in, Greencastle, you have to be in the rural part of Greencastle. It could be downtown Greencastle. That whole area is available. So the map matters there, but it's 100% financing, and the mortgage insurance is pretty minimal as well. VA, that's your military, former military or current military, 100% financing, no mortgage insurance on those. It's a great product to be able to utilize it if you do have that availability. Those credit scores are generally 620 and above for that. USDA, I should mention, I feel like their system like 660, 680, higher credit scores, lower debt to income ratios for USDA than that 50%. It's generally like 46% or below.
Okay.
Yeah.
And then conventional,
that's your 680 credit scores and above, at least 5% down or more. I pride myself on my main job is I don't think mortgage insurance is good for the consumer. It protects the lender. So it's something that you're paying on a monthly basis that you're basically throwing money out the window. I prefer to try and get people out of mortgage insurance. And luckily here at Elements, we have a first-time home buyer product with 5% down, no mortgage insurance. We've had that for a long time. We generally keep those on our portfolio, which means we keep them on our books. We don't sell them out there to Fannie Mae or Freddie Mac, which is why we can get away with not having mortgage insurance. But it's a great product. 5% down, no mortgage insurance, first-time home buyer program. And I will mention the definition of a first-time home buyer is actually anyone that hasn't owned a home in the last 3 years.
Okay. That's new to me. I didn't even know that myself.
Yeah, that's why I mentioned it. It's kind of a trick.
We bought our house this year. We did the 5% program. It was awesome. avoiding the MI was huge. I mean, it saves 150, $200 a month. You
Can
know, it's crazy. Let's just say hypothetically, I don't have a ton of money to put down on a house, but I really want to buy one. Can I still get a loan with no money down? Obviously, you mentioned USDA, VA. What other options might be available?
So the first two products would be USDA and VA. Could you potentially use those? The next part that I would talk about is, can you get a gift for your down payment from
Okay.
mom, dad, aunt, uncle, brother, sister? Is there anything like that? Maybe you have a 401k that sometimes people will take. A lot of times people will take money out of their 401k for a down payment purposes.
Right.
Um, Not saying whether I think that's a good idea or a bad idea, but people do it quite often.
Right.
And then the other fourth part would be, there is something out there called down payment assistance. We at Elements currently don't have any affiliation with anybody doing that. But there are places like Indiana Housing and INHP that, they have some programs that can theoretically help out with those. But in my mind, it's generally income based on what kind of income you have, and the more you make, the less you might be eligible for it.
Going to move now into, like, let's say we're locked in a contract on a house. What do you do as the lender, or what does the lender do over the course of the transaction?
A lender's job, from the time you get an accepted offer is, the pre-approval is you meeting in front of the loan officer and having that conversation and kind of presenting the evidence to the
Right.
loan officer.
Right.
Once you get the accepted purchase agreement, it's no longer talking to the lawyer. It's presenting it to the judge, which I would call the underwriter, and taking all those things like pay stubs, W-2s, getting an appraisal, getting title work ordered, gathering up your homeowner's insurance, and making sure that it's not in a flood zone and all those things, and putting that then in front of the judge, aka the underwriter, to make
Right.
sure that you have the proof that you need in order to be able to qualify for that particular house. So there's gathering up of documents, and sometimes, we'll present something to the underwriter, and that's going to lead to some extra questions to say, hey, all right, where did this come from? We need this document now, kind of thing.
Over the course of the transaction, we have an inspection, we have an appraisal. Tell me a little bit about the difference between those two in your eyes from a lender's perspective.
An inspection is not something that a lender wants to have anything to do with. In fact, the only thing that it could potentially do is bring negative to the table. It would be the way that I would say that. You don't want to necessarily have that. I want you to get an inspection. I want you to make sure that you're buying an investment for yourself. Make sure that the house is up to code. That's where that inspector is going to go through and pick the place apart with a fine-tooth comb to say, here's what's wrong in this room, here's what's wrong in this room. And some of those things may be deal breakers, and some may be, well, that doesn't matter to me. That kind of thing. That's the job of an inspection, to give you the power to maybe negotiate, different things to get fixed on that house. An appraisal is something that you also have to get, but we're going to look at that. That appraisal is going to establish value of that house to make sure that what you're offering to pay for it is in fact the true value of what that home is. They're also going to walk through that house to make sure it meets a certain standard of guidelines that Fannie Mae and Freddie Mac present out there, or FHA or VA. Make sure that there's floors in there, make sure that, the water works, the electricity works, the heater works, windows aren't broken, peeling paint, stuff like that. The roof in some way, shape, or form. Not to say that the roof can't be old, but if there's active leaks and that appraiser sees it, that's a problem. That's a problem.
Okay. And then just
that's
to go more
broad answer for that, because there's a lot of, I would say talk to an appraiser specifically on what they're looking at when they go through it. But for the most part,
just going more into like the appraisal itself, like what is it, and how does it affect, like, to me, I know what it is, but if you were to describe this to someone in the loan process, you get an appraisal and it comes back short. What does that mean?
Yeah. So the biggest thing there is, let's just use a simple number of, hey, I'm buying this house for $100,000, right?
Right.
And a lender's only going to loan a certain amount of money based on that. Now, USDA or VA, you could get 100%.
Yep.
But, if the purchase price is 100,000 and it appraised for 95,000, you're going to be responsible for that $5,000 difference between what the purchase price and the appraised value is, unless you negotiated that into the contract in some way, shape,
Right.
or form, or
Right.
you renegotiate to say, hey, now I'm only buying it for 95.
Right.
So, in a situation where I'm buying a house for 100,000, but I'm putting $60,000 down or $40,000 down in a $60,000 loan amount, that may not matter if it appraised for 95. You know what I mean?
Right.
That loan to value almost becomes a little bit irrelevant in that situation.
Gotcha. I know we can get into the weeds on this and the entire real estate transaction, but just keeping it super, super basic. I think that's a pretty good explanation of just what the appraisal is. Because some people don't even know what an appraisal is. Before I got into this profession, had no idea how it affected me buying a house at all. So in addition to your down payment, we're going to talk about costs here, because a lot of people are like, hey, if I want to buy a house, what are my costs up front to buy this house? So other than your down payment, what are some other costs the buyer should plan for?
Down payment is number one. And then your costs are going to be a pretty big variable, is the way that I would describe it, because the cost of buying one house versus another and what that price point is can vary somewhat on what those costs are. So there's things that are going to go into it that you need to be aware of, like an appraisal, your inspection, your title costs, what your lender's charging, setting up an escrow account at closing, paying a year's worth of homeowners insurance at closing. So those are all things that are going to go into your expenses. So, plan on having your down payment. And I would say a good rule of thumb, but by no means is this a perfect number, is to say you need to plan on $4,000 plus your down payment. Give or take a little bit, depending on what you're trying to do. If you're buying points or different things like that, I would say down payment plus $4,000 should be in the ballpark of where you need to be.
Yeah, and just from personal experience, that's the number I've been told and I've seen is like 3,500 to $4,000. That's going to cover most of your closing costs. So yeah, down payment, closing costs, and then whatever else kind of gets thrown in there. So like an inspection usually like $400 or $500, and then
appraisal about 550, 570, somewhere in that neighborhood.
And those are up to the buyer to pay those. They have to get those.
Correct.
Unless you waive your inspection.
Correct. Okay. Title costs. Cool. I don't pick who the title company is. I'm just responsible to tell you what those charges are.
Right.
That's
Absolutely.
always a fun thing to have to put those on there, but we're not the title company.
So I got one last question. It's been a great video so far. We're going to wrap this thing up with one tip that you'd give to any home buyer that's locked in a contract and they want to get to the closing table without any hiccups. What's your one tip for them?
I love this question. And I would say I'll share a story of something that happened to me early in my career. And the answer is, my wife and I were wanting to purchase a house a couple years ago, about 5 years ago. She started looking to upgrade about 10 years ago, but we didn't buy until about 5 years ago. And during that process, we got an accepted contract for the house that we were going to buy. And all of a sudden she wanted furniture for everything in there. So, she wanted to go to the furniture store and put money on a credit card to buy this stuff and that. And I said, no. Yeah. I said, here's what happened to me early in my career. And this is something that to this day cracks me up. I had a buyer. debt to income ratio was pretty tight. It was really tight. And we get to a few days before closing, and oftentimes you have to pull what's called a credit refresh just to make
Okay.
sure that, have any new accounts been opened? Did they go and buy an auto, a car or whatever? On this particular situation, something popped up that he had opened a credit card at a jeweler
Right.
and now had a payment for about $500 a month. And that new $500 a month payment was going to be a major problem to the transaction. So I call this customer up and I said, hey, I noticed that you opened up a credit card with a jeweler. What's going on there? He goes, oh, Chris, I forgot to tell you, we got engaged. I bought an engagement ring and I proposed to her in the backyard of the house we're buying. And I went, oh boy. I said, I'm gonna break your heart right here, man. But I said that credit card payment now has to be in your debt ratio, and you no longer qualify to buy that house. So,
Wow.
Long story short, he ended up taking the wedding ring back.
Yeah.
He got it taken off of his credit and ended up buying the house. But have that conversation with your loan officer of if you can, afford to open up a credit card or get a new car or trade a car in. I'm not to say that everybody can do those things, but there's times that doing it could really throw a wrench into the transaction and cause major problems. I had a guy retire in the middle of his in the middle of the we did a verification of employment 10 days before closing. Oh, Mr. Smith's retired. What?
Yeah.
His income went from what it was to no longer the same, and that took some time to clean up. So have those major conversations with your loan officer about what's a good idea, what's not a good idea.
So like it usually takes 30 to 35 days to close out a loan. So you just got to wait about a month. Stay clean for a month. Don't touch your credit. Don't go buying anything crazy for a month. And then once it's at the closing table, you should be good to go.
That's right.
Awesome. Well, Chris, I appreciate you doing this video. Really, really got into some good stuff here. Hope the people looking and viewing learn a thing or two. If you want to find me, if you need help with anything, again, my name is Zach Archer. Phone number is 317-292-1933. Email is Zach@CrestPointIndy. And Chris, if people want to use you as their lender, if they have questions for you, how do they reach you?
Couple ways. Easy way is my phone number, 317-201-7334, or you can email me at ckerr@elements.org.
Okay. Perfect. Well, appreciate it, Chris. Thank you very much for taking the time out of your day to do this. And I think it was a very informational video. I think went very well. Thank you.
My pleasure, sir.